Hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. Special edition today, something I do each and every year called Put These Charts on Your Wall. This is the 2025 edition. Excited to bring this to you. So without further ado, let's begin. Put these charts on your wall for the next time you think all-time highs are a sell signal. Now, this is something you probably heard this year. You certainly heard it last year. The reason for that is we're seeing a lot of all-time highs. 18 so far in 2025, 57 in 2024. That was the fifth most of any year in history. So why not buy low, sell high? Why not sell when the market's at a high? Well, the reason is if you're a long-term investor, 20 years, 30 years, 40 years is your time horizon, you're going to see many more all-time highs regardless of what the market does in the short run. So you could always see an all-time high that's followed by a bear market. In fact, we saw that early this year from February to April. The market was down over 20%. That followed a previous all-time high, and then the market recovered, hit another all-time high. Could this be the same situation? Could the market peak have just occurred and there be another bear market here? Absolutely, that could always be the case. But if you're a long-term investor, 20, 30, 40-year time horizon, you should expect the economy to grow, you should expect earnings to grow, and you should expect earnings to drive the market higher. So you're going to see many more all-time highs going forward. And if we just look at the data, it really bears that out. If we're just looking at the S&P 500 and saying, well, what has happened when the market's been at an all-time high versus other time periods? And kind of shocking here, over the next 1 year, 3 year, and 5 years, you tend to see the S&P 500 actually outperform other periods following an all-time high. Looking at over the next 1 year, 13.5% return. That's above average. 44% return over the next 3 years, 82% over the next 5 years. And over 10 years, you could see it trails a little bit the other time periods, but still up 158%. So certainly not a sell signal. So when it comes to all-time highs, probably the most intelligent thing that you can say is, well, it's simply likely to be followed in the future by more all-time highs. That's the most intelligent thing I think you can say. You definitely can't say that it's some kind of sell signal by itself. Investment returns are linear, and wouldn't it be nice if this were the case? Wouldn't it be nice if that 10% return that equities have delivered since 1928 have come each and every year? You get that 10%. Obviously, that's not the case. You could see that in the chart here. And what you're seeing here is the returns on the S&P 500, annual returns, and they're rarely around that 10% number. So you're going to have many years that are negative, 1 out of every 4. You're going to have years that show huge returns. In 2023 and 2024, we saw the S&P 500 above 25% in each of those years, which simply means returns are lumpy. You don't get that 10% coming in an orderly fashion. You can have a big down year followed by a big up year, and you rarely have that nice orderly 10% number. And even looking in within a particular year, like we've seen in 2025, there's no order to that as well. So if you look at that 10% average and you break it down to a monthly return, it's about 0.8% per month. Historically would be the historical average, but once again, it's rarely around that 0.8% number. We've seen that this year with a big down movement. Earlier in the year, we had a bear market for the S&P 500 down over 20%. And then this huge dramatic recovery up 34% from lows for the S&P 500. And this is why timing the market is so difficult, because following bear market lows, there isn't a linear type of advance. So you don't tend to see, let's say, that average 10% return over the next 12 months. You tend to see the market snap back in a much more dramatic fashion. I'm showing you here the bear market lows in the S&P 500 return over the next 12 months following those lows since 1949, and the average return is 46% over the last year. We don't yet have a full year return from that April 8th bear market closing low this year, but the market's up already over 30% from that closing low. It's oversold, it's overbought, and it can't possibly go any lower or higher. You'll hear this every single day because there's always something in the market, if you're looking at a stock or an ETF, that's oversold or overbought. And you'll hear these types of sayings. And here's one example in terms of the oversold level. We're looking at Moderna here, one of the high flyers during 2020. Obviously, not the case anymore. You can see here last year, if we're looking back a year ago, it was oversold. It was moving lower, it was oversold, but that doesn't mean that it has to bounce. It doesn't mean that it can't go even lower. We can see many more oversold levels, and you could see where it is today substantially lower. So something that's oversold can get more oversold. It can stay oversold. It doesn't mean that it has to go up. It's just an indication that it's gone down a lot. And you tend to see with these worst performing stocks or best performing stocks, you tend to see that momentum continue in that direction. And if we look at the flip side here, Palantir would be obviously the example of an extreme overbought level that just continues in that direction. You can see a year ago where Palantir was much, much lower, and it was overbought, and it didn't respect that whatsoever. It continued to be overbought many, many more times over the past year. It was the best performing stock in the S&P last year, and once again in 2025 so far this year as well. Overbought, oversold. These are interesting technical indicators, but when there's extreme momentum going on, the market doesn't respect that. It can continue in that direction for much longer than you think. Credit spreads can't get any tighter. You probably were saying that coming into the year, but in January of this year, they got even tighter. This is looking at high yield credit spread, so the spread between what a high yield bond is yielding versus a similar duration treasury security. And in early this year, it reached 2.59%. So that means junk bonds had a yield only 2.59% above treasuries. That was the tightest we've seen since June 2007. Now, can this go even lower? Well, yeah, it could break below the lows that we saw, the all-time lows. So it can always go lower. This is historically low. This doesn't mean that you should expect it to go lower, but nothing is impossible. Clearly, investors can get more and more optimistic, and they can drive credit spreads even lower than today. Stocks can't go up when the Fed is shrinking its balance sheet. So you often hear that QE is really bullish, and the opposite when the Fed is shrinking its balance sheet is bearish. But when you look at the data, it really doesn't support the notion that stocks can't rise when the Fed is shrinking its balance sheet. You could see over the last 32 months here what the Fed has done in terms of its balance sheet. It's shrunk its balance sheet by over 20%. What has the S&P 500 done over that period of time? It's up over 70% on a total return basis. So clearly, the stock market isn't dependent on quantitative easing to go higher. It can go much higher even when the Federal Reserve is shrinking their balance sheet. An inverted yield curve means a recession is imminent. This is something that you'll hear all the time because an inverted yield curve has been a pretty good predictor of recession. The problem is it hasn't been consistent in terms of when that recession will occur. You can see that in this table here. Huge variability, 50 months following the inversion in 1965 before a recession began, and then you have as short as 11 months following the September 1980 inversion. In this cycle, we saw the yield curve first invert in October 2022. When did the recession begin? Well, we're still here now in 2025, almost 3 years later, still no recession. Does that mean we won't see a recession in the next year, next 2 years? Of course we could see one. What it means is this is not a very good indicator in terms of timing. So we could see a recession in the next few years, or it could take 50 months. It could take even longer than 50 months. Perhaps there will be no recession this time, and this indicator will have failed. So an inverted yield curve has been a pretty good predictor of a recession in the past. It just hasn't been a good predictor in terms of telling you when that recession is going to occur. And really, a lot of professional forecasters were putting a lot of weight on that inverted yield curve indicator. If we look back to early 2023, we saw just a record number of forecasters predicting and anticipating a recession. And as of now, everyone has been wrong because there hasn't yet been a recession in terms of the U.S. economy. And just speaking of recession, earlier this year I did a poll back in April. This was when the stock market bottomed on the day really of the lows here on April 8th. This was in the midst of the tariff tantrum and the market was down 20%. I asked, will the U.S. economy fall into recession in 2025? And two-thirds of people said yes. And looking at the recession odds on Polymarket, this is a betting site where you can bet whether the economy will be in a recession. Similar odds on there at the time, and you can see since then the odds have just gone lower and lower and lower again. And what this basically tells you is the stock market is not the economy. The stock market can be going down a lot, and there can be no recession. We've seen that now a few times in the past few years. We saw it in 2022. People thought there was going to be a recession because the market was down big that year. We had a bear market, and people thought that again from the February to April period. That doesn't mean that the next bear market won't be associated with recession. It just means you can't say for sure that the stock market going down is an indicator of an imminent recession. The April example being the latest one here. The housing market can't get any more unaffordable. I think that was a reasonable thing to say coming into the year, just given how unaffordable it was entering the year. But it's gotten even worse in terms of affordability, which is a pretty incredible thing here. What I'm showing you is the affordability gap between the income that you need to purchase a home in the U.S. versus the actual income. And you can see a 57% gap between the two. This is at the absolutely most unaffordable housing market in history, much worse than what we saw during the last housing bubble in the mid-2000s. Another way to look at this is to say, well, what percent of your income would you need to purchase the median home for sale? And today it's at 48% of your income, a record high, above what we saw last year and above the peak of the housing bubble in the mid-2000s. Vacancy rates can't go any higher. This is looking at office vacancy rates. They continue to hit record highs, now up over 20% here. And again, still trending higher in the U.S. So the transition from working in the office to a hybrid or work from home model really has not snapped back, although you're continuing to hear companies calling their workers back or requiring more days in the office. We're still seeing this vacancy rate trend higher. This is the highest level we've ever seen in the U.S., over 20%. So over 1 in 5 is vacant at this point. That's higher than what we saw during the financial crisis, higher than during the 2001 recession period. So highest levels we've ever seen. Can it continue to go up? Of course it can, because there is no upper limit in terms of any of this stuff. You can't trust all government data on inflation, and the best illustration of that is simply looking at how the government calculates health insurance inflation in the U.S. It's absolutely absurd. 5 years ago, we have this index at 185. Today, it's at 149. That's showing a decline of 19% in terms of what they're saying health insurance did in terms of cost over the last 5 years. And that, of course, that's absolutely absurd. That's absolutely insane, because anyone who's actually paying for health insurance knows that it only goes up. If we look at the period here from 1999 to 2024, look at the average family health insurance premium in the U.S. It's gone up 342% over that period of time, way higher than overall inflation. And just looking at the last 5 years, because that's what this chart illustrates, it's not down 19%, it's up well over 20% in the last 5 years. So be very careful trusting the government data in terms of inflation. And if we look at the inflation rates over the past few years, and we look at the average rate of inflation, what you can see here is it's nowhere near the 2% inflation that the Fed is talking about in terms of that's their target. They're talking about we're back at 2%. You can see here, if we look at any time period and we use just the government statistics in terms of inflation, well, there is no 2%. CPI is averaged actually over the last 5 years, 4.6% per year. And if we look back the last 13 years, that's when the Fed started their inflation target at 2%. You could see it's averaged 2.7% over that period of time. They won't print more money. And this is not a bet that you should be making, because if you look at this chart here, clearly the expectation is that they're going to print more money here. And you can see we just had a little hiatus in terms of the money supply going down after that huge spike in 2020 and 2021. It actually pulled back for a little while. We hadn't seen that historically, but they changed course here, and you can see they're printing money once again back at an all-time high. It's the easiest thing to do, is to print money. No one wants to take the pain of being responsible in terms of the money supply. So this is a trend, unfortunately, that's likely to continue. And it's not just that the money supply is going up, it's that it's going up at a rapid pace that causes the inflation that we've seen in the past few years. You can see the huge spike that we saw in 2020 and 2021. We had never seen that before in history. And really, the solution to the next crisis will likely be the same. They're going to try to throw as much money at it as possible, which means that your expectation should be there's going to be a lot more inflation in the future. They won't kick the can down the road. You hear this every time the president gets elected. They talk about being prudent, balancing the budget, trying to control spending, all the rest of it. And then if you look at the actual data, you can see whether it's red, whether it's blue, whether it's Republican or Democrat, the one thing that's constant is their willingness to kick the can down the road. They want to get reelected. Nobody wants to rein in spending. No one wants to take the pain of balancing the budget on their watch. So what we see is the national debt trending higher and higher and higher here. You can see where it was 10 trillion under George W. Bush in January 2009 when he left office. Then Obama left office, 19.9 trillion. You could see Biden left at 36.2 trillion, and we've already added a trillion to that in about 7 months under Trump's second term. Where should you expect this to be in a few years? Well, we're running a deficit of about $2 trillion in terms of the federal government. So we're spending $2 trillion more than we're taking in tax revenue. So we should expect this to go much higher in the next few years. We're going to see 40 trillion most likely, unless something changes. The one constant is more debt, because nobody wants to cut back on their watch. The international stocks will always underperform. And the reason why people were saying that is because it was 16 years of underperformance heading into this year. So you heard of a lot of claims like international stocks are dead forever. And then what happened in the first quarter of this year, where we saw an extreme reversal? International stocks outperformed US stocks by over 10% in the first quarter of this year, one of the biggest outperformances that we've seen on record going back the last 30 years. And so far, year to date, that trend has continued here. You can see as of August here, international stocks up 23% on the year versus 10.5% for US stocks. And what this basically means is there's a cycle to everything. There's US outperformance, there's international outperformance. And historically, that we've always seen them go back and forth in cycles. We just had never seen a cycle as long as this where US stocks were outperforming. Now it's snapping back, but not in a linear fashion, in a dramatic fashion. If we look at this chart here showing you global equity returns, you can see the US in the bottom third in terms of countries, and huge outperformance for many countries, particularly in Europe, Eurozone, up over 30% on the year. Growth tech stocks can't possibly outperform any longer. Again, That would have been a reasonable expectation, I think, entering the year, but they've pushed even higher. We now have growth stocks versus value stocks at a record high, surpassing the peak from March 2000. Will it stop here? It could. Will it continue? It could as well. There's no upper limit. We've seen now huge outperformance from growth stocks versus value stocks over the last 15 plus years. And a lot of that's been driven by the outperformance of technology versus the broad market. You can see here that too at a new record high, surpassing the previous peak from last year and March 2000. Markets follow a normal distribution. Of course, they do not. How do we know this? Because fat tails or big moves in the market happen much more frequently than a normal distribution would imply. And you can see here what I'm showing you is the best and worst 100 trading days going back to 1989. And what they tend to do is they tend to cluster. They tend to happen in short period of times. And if we dig into the data and we look at the number of these big moves up and down, well, it's not predicted by a normal distribution model. You shouldn't be seeing moves this big occur in this period of time. In fact, you should really never see moves like we saw back in April. And I'm showing you the returns, biggest one-day gains for the S&P 500 since 1950. We had the third biggest one-day gain happen on April 9th. That was following the low, so a huge snapback, huge reversal. The market was up 9.5% that day. That was a 9 sigma or 9 standard deviation event. And basically, if you're looking at a normal distribution, that shouldn't happen. That should happen basically once every 500 billion years or so. And if we look at how old the universe is, 13.8 billion years is the estimation there. So basically, this should have never happened in the history of the universe. But yet you can see, not only did it happen, but in 2008, we actually saw 2 days that were even bigger in terms of gains, which simply means the market doesn't follow a normal distribution. It has these fat tail events that happen with much greater frequency than would be implied by that normal distribution. Biggest companies can't get any bigger. Of course, there is no such thing as can't, and they've gotten bigger. NVIDIA being the prime example so far this year. Biggest company in the world now, 4.5 trillion market cap, 8.1% of the S&P 500 in just NVIDIA. That's the biggest for any individual stock in the S&P 500 with data going back to 1980. So even bigger than Apple's weight from last year, which was also a record. And if you combined NVIDIA and Microsoft, over 15% of the index in just those two stocks, that's also a record going back to 1980. And if we take the 10 largest holdings in the S&P 500, here too we see another record in terms of concentration, 38% of the index. So what this means is the largest stocks are once again outperforming the average stocks or smaller stocks, and you can see that in the ratio here between U.S. large caps to U.S. small caps, highest we've seen since April 1999. Cars are appreciating assets. That's probably sounds like a ridiculous concept because you probably heard the saying, like the minute you leave a car dealership after you buy a new car, it immediately goes down in value. But back in 2022, during that period of time, you could call it a mania, you could call it in the inflationary period, but that combination of factors led people to actually believe that a used car would go up in price, and it did go up in price, and went up in price a lot. There was a supply-demand imbalance, and you had headlines like this: EV demand is so hot that Tesla owners are flipping their cars like houses. And so you saw this brief moment of time where these cars were appreciating assets, and people at the time, if you look at the headlines, thought this would actually continue. It did not continue. You can see here after the average used price of a Tesla peaked here in 2022, we've seen nothing but declines, now at a record low, down about 60% from that peak, which is normal. And that should be your expectation when you buy a car. If it's not a collectible car, if it's not something in short supply, it should go down in value because of that usage, that age of the car, and the fact that you need to put more money into it to repair it as it gets older and older. So this is actually a normal period of time that we're seeing today. This was very much abnormal when we saw this kind of mania for EV and that hyperinflation period for that brief moment in time. Past performance is indicative of future results. Of course, it's not. This is the disclaimer you always hear, but it's tempting to believe that it is. If we look at an individual stock like United Healthcare, it was a huge outperformer for a 10-year period here ending in 2023, up 714% versus the S&P 500's gain of 209%. And people just looking at this chart would say, well, that should continue. If we saw this huge return over the last 10 years, we're likely to see the same over the next 10. So far, that hasn't been the case. The return since then, the S&P 500 has continued higher, up 35%. United Healthcare stock, meanwhile, cut in half. Picking stocks is easy. Just buy what you know. You probably heard this. This is the famous Peter Lynch adage, and people say that it's just as easy as you use this product, you know this product, buy what you know. If it were only that easy, of course, everyone would be picking stocks and making money and outperforming, but it turns out it's much harder. Here's the latest example of that. Last 5 years, S&P 500 up 105%, and Lululemon, very popular. A lot of people consume this. A lot of people go to their stores. You can see down 44%. So just buying what you know is not a sufficient reason to think that a stock is going to outperform the market in the long run. A valuation can't go any higher. There's no such thing as can't in markets. We could see this in terms of Palantir. This is shocking. It's shocking even to me, and I've seen many of these charts historically, but very few get to this level in terms of a price to sales ratio. 137 times sales in terms of Palantir. You could see back after it went public, it went as high as 57 times sales. Then the stock crashed, went down a lot, was down to about 6 times sales, but now since then the euphoria over the name has driven it to 137 times sales. There's no upper limit in terms of these ratio. It's really just a matter of sentiment, and as long as investors believe the future is going to be much better than today, they can drive these valuations up to seemingly insane levels. And speaking of that, a high valuation is a sufficient reason to short a stock. Of course, it's not. I'm using the same example that I used last year. Palantir here once again. The forward PE ratio seemed pretty high entering the year. It was at 88 times. You could see where it is today, over 200 times forward earnings for Palantir stock. Just an incredible level. You could see what the stock price has done, more than doubling this year, up about over 10x since the beginning of 2024. So shorting a stock based on valuation alone is obviously a very dangerous game to play. Investors are rational. They most certainly are not. I know that's the theory in terms of modern portfolio theory. You're supposed to assume that investors are rational. They're going to make rational decisions. That might be true in the long run, but in the very short run, there's so many examples illustrating that investors do things that are completely irrational. One of those things can be buying meme coins here like Fartcoin and driving it up to a market cap of 2.4 billion like they did earlier this year. And it was worth at the time more than 1,200 companies in the Russell 3000 index. Of course, that doesn't make sense. Of course, that's an absolutely ridiculous concept, but investors are not rational. So they see something going up, they think it's fun, they buy into it, drives up to this crazy level. It actually crashed over 90% following that peak. But once again, there were enough irrational investors to buy this thing once more and bring it back up. Didn't get back up to the prior high, but still, as it stands today, much higher than you would assume based on a rational market. So very much the case that investors are irrational, particularly in the short run, because they're driven by sentiment, they're driven by fear and greed. And in this case, of course, they're driven by FOMO. So they see something going up, they're hearing about someone making money on them. So they ignore the fact that this is a thing called Farcoin. It has really no value, and it's the supply is not in short supply, and they're driving this up to insane levels. So there'll be many more examples of this in the future because investors are not rational. Profits don't matter anymore, and I'm saying this in tongue in cheek here because, of course, they matter, but you often hear this when a name is at a mania phase. Beyond Meat was a mania stock when it came out in 2019. It could do no wrong. It shot up to crazy, crazy levels in terms of valuations, and it actually was above $230 per share. Now, it wasn't making money at that time, but people said, ignore that. Profits really don't matter. All that matters is growth, and this thing is going to grow so fast that profits really don't matter. And it did grow its sales for a period of time at a rapid pace, but it never became profitable. You can see here each and every year losing more and more money, and the cumulative losses now are enormous. This year so far, 82 million in the first 6 months of this year. Last year it lost 160 million. The year before that, 338 million, and on and on and on. But profits, here's the difference versus 2019. Investors really are evaluating the stock now based on earnings, based on profits. And in the long run, this is what happens. The weighing machine takes hold, and you can see Beyond Meat shares are down now 99% from their peak in 2019. And if they can't turn a profit, if this continues, well, of course, the inevitability is the company goes bankrupt. If they turn around, if they can cut expenses, if they can grow their revenues, grow their profits, sure, the stock can turn around, but eventually the weighing machine will take hold, and you can't lose money forever as a company. It can't go to zero. There's a temptation to say that with many individual names. Any individual stock can go to zero. Let me say that again. Any individual stock can go to zero. And there was a lot of euphoria a few years ago around this name called Nikola. It was caught up in the EV boom. It peaked in June 2020. This is split adjusted, but over $2,400 per share. Just incredible, incredible mania. A lot of excitement running into the name. You could see this year files for bankruptcy, essentially zero, trading for pennies on the dollar. Any individual stock can go to zero, and just when you think the prospects are at the best, well, things can change in an instant. But I'm sure the entire way down, there were people buying the stock saying, well, it can't go to zero. It has to come back at some point. Just remind yourself, put this on your wall as a reminder, it can go to zero. Any individual stock is much different than buying the entire market in terms of an index fund or buying a diversified portfolio of many different asset classes. That will eventually come back because earnings will be higher, the economy will grow, the recession will end. Any individual stock, you can't say the same thing for. There are times where it will never come back because it files for bankruptcy. Dividend yields can't go any lower. We just saw the lowest dividend yield for the S&P 500 at the end of the second quarter since 2000, 1.25%. Could it go lower from here? Absolutely. Could it break the lows from the 2000 period, dot-com bubble peak? Absolutely. There's no lower limit in terms of the yield. If prices are going up more than those dividend increases, you're going to see yields fall. That's what's been happening the past few years. Prices going up way more than dividend increases, and you're seeing that yield go down as a result. Bonds are risk-free. A lot of investors, I think, thought that before the 2020 peak in bonds. Hopefully, they're not saying this anymore. This is now by far the longest bond drawdown in history, over 5 years and counting. The biggest drawdown during that period, the peak drawdown, over 17%. So that is not risk-free. That's an illustration of that. You could see it in the chart here, just this time period, 5 years without a new high for the U.S. bond market. And if you dig in, you look at long duration bonds, this is absolutely incredible. Investors should really understand this in terms of the long end of the bond market. When you have interest rates rise from very low levels, you can see extreme pain. You can see pain even worse than the stock market here, actually much worse with this 25 plus zero coupon treasury ETF down over 60% from its peak in March 2020. So you can see what the reversal in long-term treasury yield. So the 30-year goes from below 1% to over 5%, what that causes in terms of this bond. So bonds, most certainly not risk-free instruments. Buying something based on a meme is a good idea. Of course, it's not a good idea. It may work in the short run, but certainly not a good idea. I think the best example of that this year would be the Melania meme coin, which came out January 19th. Here's the meme. Here's what they're talking about here. You can buy it with your credit card. If you bought that Melania coin based on that meme back on January 19th, you'd be down around 99% today. Market leaders never change. It seems like the leaders of today will be the leaders of tomorrow. Look at the top stocks today: Nvidia, Microsoft, Apple, Amazon, Google, and so on. These are all household names, but you don't have to go back very far to see an entirely different list. In 1990, here was the top companies: Exxon, GE, IBM, AT&T, Philip Morris, Merck, Bristol Myers, DuPont, Amoco, Bell South. None of these names are in the top 10 stocks today in terms of the index. And if we go back at 2000 and we look at the list of companies here, only Microsoft remains today. So the leaders seem like they'll never change in the future, but there will be new companies, just like Nvidia was not on anyone's radar 10 years ago. Now it's the largest company in the world. There will be new leaders in the future, and this is really a chart suggesting that you need to be diversified because we don't know who those new leaders are going to be in the future. Making changes to your portfolio based on headlines is a good idea. Absolutely not a good idea. We see this headline every year. Now there's one more reason for stocks to sell in May and go away. Very catchy saying, sell in May and go away. Where you're supposed to go, I'm not sure, but what they're telling investors is to get out of the market because they're saying that stocks will go down from this period in May, from May through October. As I've talked about before, the data does not suggest that that's the case or that's what you should do whatsoever. The market, although it has a lower average return during this period of time, is still positive. So you still have about 6.6 annualized return during this period since 1928. Why would you want to miss out on that? You wouldn't. And if we look at the percentage of positive returns, there's almost no difference, which means that there have been a few May through October periods that are really dragging down this average return. If you followed this advice this year, what you would have missed out on, well, so far 16% return from the beginning of May to today for the S&P 500. So don't invest based on headlines, based on these adages. Do your own work. And seasonality in terms of the market, yes, there are things that have happened in the past on average. That doesn't mean that you should rely on that as a predictor of the future. Rising national debt must be bad for the stock market. I talk about the national debt all the time. I do think it's a concern for the country, potentially for the economy at some point in the future. But in terms of investing, it's not a signal for investors whatsoever. We can see here we're at 37 trillion in terms of the national debt. We're going to hit many more of these milestones in the next few years because we're running $2 trillion deficits. But if we look at the past 30 years, it would have been a big mistake to say the national debt is going higher and that's a reason to sell stocks. National debt is over 7 times higher than where it was 30 years ago. What has the S&P 500 done? Total return 1,900+% over this period of time. So clearly the stock market can go up with national debt rising. And why are the two very different? Well, I think it's because companies don't behave the way the government does, in terms of companies are trying to make profits. Profits have gone way up over the last 30 years. That's been the biggest driver of returns for the S&P 500, the fact that earnings are much higher, which means that companies make more than they spend. So the exact opposite of what the US government does each and every year, which is run a deficit. Currently, that's 2 trillion. The corporate America does not operate that way. If they did, stocks wouldn't be up 1,900% if they were running net losses for the past 30 years. They're trying to be more efficient. They're trying to be more profitable. So when it comes to investing, it's the national debt and the stock market, two very different things. Big returns come without big drawdowns. That's absolutely not the case. You should not expect that. Anything with a huge return, you should actually expect a big drawdown at some point along the way. And all of the big winners I'm showing you here, the stocks that I call the enormous 8, so the Mag 7 plus Netflix, and you can see just eye-popping returns over the last decade, from Google, 487%, to NVIDIA, beating everything else, 36,000 plus percent return here. And all of these stocks, without exception, have had huge drawdowns, bigger drawdowns, in fact, than the S&P 500 over this last 10-year period. NVIDIA down 66% at one point, Tesla 74%, Microsoft 37%, Netflix 76%, Meta 77%. So huge drawdowns along the way. There's no way to avoid that. You're not going to have a big return, whether it's in a stock or the stock market as a whole, without enduring these drawdowns. There's no reward without risk, no upside without occasional downside. This has to be the top, and this is something that I've been illustrating a lot over the past year and a half, because Bitcoin has been hitting new all-time high after new all-time high. I'm highlighting in yellow here the record highs in 2024. You can see hit 69,000, went all the way up to 108,000 by the end of last year. Many people saying at each of these, this has to be the top. It has to be the top. There will be a top, just like the stock market at some point, after which there'll be a big, big decline. No one knows where that top's going to be in 2025 so far. We've seen it move from 108,000 at the peak in 2024 all the way up to 124,000. Could that be the top? Of course it could be, but it doesn't have to be. It could go down 50%, it could go down 80%, it could hit more all-time highs. Nobody can predict the future. It never has to be the top when we're talking about an asset. It can always go higher. A bad start means a bad finish. This year, crazy start to the year, fourth worst start for the S&P 500 in history, down over 15% through 66 trading days. You can see in rare company, we're talking about 1932, 1939, and 2020, only years that were worse than this year through 66 trading days. And what I talked about at the time is it's not preordained. We could see a rally. We saw it in 2020. We saw it in some of these other years. We could see the market recover. No one seemed to believe that, but we actually did get a huge recovery. We actually did get a huge comeback. The year isn't over, but the S&P 500 has mounted one of its biggest comebacks ever, up 10.5% as of mid-August, actually now above the average year at this point in time. So a bad start doesn't have to mean a bad finish. Oftentimes you see reversion to the mean. Oftentimes you see snapbacks. This year has just been a unbelievable comeback, bigger than we've seen in quite some time, but we saw it in 2020. We knew that it could happen. So far, it's happening again. And I'd say the flip side is also true. A good start doesn't have to mean a good finish. The markets aren't orderly. They're not linear. They're not predictive in terms of what has happened over the past week, past month, past year. Doesn't mean that's going to continue necessarily in the future. The market will never come back from this bear market or crisis. And I can understand this feeling, because when you're in the midst of a crisis, it seems like it will go on forever, it will never come back. I show this chart a lot because it really illustrates that with the passage of time, you often forget about the crisis. And sometimes you'll remember, of course, remember the financial crisis if you lived through that, or 9/11, the dot-com bubble crashing. But many of these other ones you likely have forgotten at this point in time. And with the passage of time, even the worst crises, you see a recovery. And the reason for that is that every recession is followed eventually by an expansion, which means that the economy is growing again, GDP is hitting a new high, earnings will come back, earnings are higher, and in the long run, earnings drive stock prices. So even this year, with the second tariff tantrum, it's been now seemingly forgotten about, markets back at new highs. If you would have ignored all of these crises along the way, a dollar in 1989 would have grown to $38 today, including dividends. And if we look at bull and bear markets, there's really no comparison. Bull markets far outweigh bear markets in terms of their duration, in terms of their cumulative gains. And that's why you see positive returns over time, is that the good times last much longer than the bad times. Even though you remember those bad times, I think, more vividly, and you can have sharp moves lower in a short period of time, it's the good times that last longer. The bull markets on average over 5 years, 254% on average higher in terms of the cumulative gains. Bear markets last about a year on average, taking the market down about 31%. And we can see this year, the very short bear market, 0.1 years, 19% decline on a total return basis. But you could see that the market has recovered from all of these bear markets in the past. It has recovered from this one already. Will there be another bear market in the future? Absolutely. Will the market recover from that? Absolutely, once again. You should mix politics with your portfolio. You definitely should not. I know that everyone has a particular party that they like, a particular president or dislike. Maybe you don't like any of them, but you shouldn't let that influence your investing decision. It's decisions you're going to be tempted to because you're going to see headlines like this. In 2008, Dow sinks day after election. Obama's going to inherit a bad economy. Markets plunge worldwide as Trump surges to the White House. This is 2016. And then in 2020, Biden blue wave could crush these parts of the stock market. It's a big mistake to let this influence your investing decisions, to let your own personal beliefs about politics suggest that you should make changes to your portfolio. Over time, the market's higher because profits are higher, and that happens during the red elections, during Republican administrations. That happens during blue elections, Democratic administrations. You can see the last 4 administrations here, the S&P 500's return, 102% for Obama's first term, 66% Obama's second term, 83% Trump's first term, 65% Biden's term here. Don't mix politics with your portfolio. And that brings us to our last chart here. Putting money under your mattress is an effective strategy to combat inflation. And when I show one chart, why you need to invest, this is it. Basically, your purchasing power is almost assuredly going to go down, and go down a lot over the next 30 years. The last 30 years, this is pretty typical. We saw a 50% decline in the purchasing power of the U.S. consumer dollar, so over cut in half. What would have protected you against this decline? Well, being an owner, being an investor, the S&P 500 during the same period of time has not only kept pace with inflation, but outpaced it by 874%. That's about 8% per year. That's definitely above the long-term historical average. But I think the point here is that there's going to be inflation in the future. There's going to be decline in your purchasing power. And the best way to protect yourself and grow wealth over time, in spite of that decline, would be to be an owner, to be an investor. This is why you need to invest. So they say a picture's worth 1,000 words, and when it comes to markets, that's absolutely true. Having a few extreme charts on your wall can serve as a helpful reminder that there's no such thing as can't, won't, or has to when it comes to markets. The market does what it wants, when it wants to. It's the real-time personification of collective human psychology with fear and greed and all of the other human emotions on full display. And that's what makes it so hard and at the same time so interesting, because there are times where skepticism is completely warranted and other times where you have to suspend disbelief, but there's no manual to help you decipher which situation applies. So find some charts that speak to you personally and put them on your wall as a constant reminder that the range of possible outcomes is much wider than any of us think, for there is no impossible in markets. Thank you everyone for joining me on this special edition. If you're not already subscribed to our YouTube channel, hit that subscribe button for all the latest content from us, and I'll see you next time on the Week in Charts.